Welcome back to Financial Market Insights for Traders. I'm your host, Sophia, and today we're diving into a topic that every investor, whether beginner or seasoned pro, needs to understand: portfolio diversification, stocks versus bonds. If you've ever wondered whether your investment portfolio is properly balanced or how you can protect your wealth from market volatility, then this episode is for you. We'll discuss how stocks and bonds differ, how they work together in a diversified portfolio, and most importantly, how to determine the right mix for your financial goals. Diversification is not just a fancy buzzword, it's the foundation of a successful investment strategy. So, let's get started by answering a basic but critical question. What is portfolio diversification and why does it matter? Diversification is like having multiple streams of income. You don't rely on just one. Instead of putting all your money into one type of asset, like stocks, you spread it across different investment types to reduce risk. Think of it this way. If you put all your savings into just one company's stock and that company faces a financial crisis, your entire investment could suffer. But if you own a mix of stocks, bonds, and other assets, a downturn in one area may be offset by gains in another. Historically, stocks and bonds tend to move in opposite directions. When stock prices drop during an economic slowdown, bonds often perform well as investors seek safer assets. This balance helps stabilize your portfolio and smooth out those dramatic ups and downs. Now, let's break down stocks and bonds individually so you can understand how they fit into your investment plan. What are stocks? A stock represents ownership in a company. When you buy a stock, you become a shareholder, meaning you own a piece of that company. If the company grows and performs well, the stock's value increases, and you may also earn dividends, regular payments to shareholders. But stocks are known for their volatility. Prices fluctuate based on factors like earnings reports, economic trends, and investor sentiment. One day, a stock could be up 5%, and the next, it might be down 7%. That's the nature of the stock market. Types of stocks. There are different types of stocks, each with unique characteristics. Common stocks, the most typical type, offering voting rights and potential dividends. Preferred stocks provide fixed dividends and take priority over common stocks in the event of bankruptcy. Growth stocks, companies that reinvest profits to expand rather than paying dividends. Dividend stocks, companies that consistently pay dividends, providing a steady income stream. Blue chip stocks, large, well-established companies with a strong track record of stability. Stocks have historically provided higher long-term returns compared to bonds, making them attractive for wealth building. But with that potential reward comes higher risk. What are bonds? A bond is essentially a loan. When you buy a bond, you're lending money to a corporation, government, or municipality in exchange for interest payments and the return of your principal investment at maturity. Bonds are considered lower risk investments compared to stocks. They provide steady income and are more predictable. But because they're safer, they also tend to have lower returns over time. Types of bonds. Government bonds, issued by governments and considered very safe. Examples include U.S. Treasury bonds. Corporate bonds, issued by companies and often offer higher returns, but carry some risk. Municipal bonds, issued by local governments and can provide tax advantages. High-yield bonds, junk bonds, higher-risk corporate bonds with higher potential returns. Bonds are particularly useful in a portfolio to balance stock market volatility. When markets crash, investors flock to bonds for safety, driving bond prices higher. Stocks versus bonds, how they compare. Let's do a quick side-by-side comparison. Features of stocks versus bonds. Ownership. For stocks, you own a share of a company, while for bonds, you are lending money to a company or government. Risk. Stocks demonstrate higher risk and volatility. Bonds, on the other hand, are lower risk and generally stable. Returns. Stocks have higher potential for long-term growth. Returns on bonds are lower, but provide steady income. As far as income is concerned, some stocks pay dividends, but not guaranteed, while bonds generate fixed interest payments over time. Market reaction. Stocks thrive in strong economies but drop in downturns, while bonds tend to rise when stocks fall, providing balance. The key takeaway? A well balanced portfolio includes both stocks and bonds to manage risk and optimize returns. How to balance stocks and bonds in your portfolio. So, how do you decide the right mix? It depends on factors like risk tolerance. Are you comfortable with market fluctuations or do you prefer stability? Investment horizon. Are you investing for the short term or long term? Financial goals. Are you looking for growth, income, or a mix of both? Here are some general allocation strategies based on risk tolerance. Conservative investor, low risk tolerance 80% bonds, 20% stocks, focus on stability. Moderate investor, balanced approach 50% stocks, 50% bonds, a mix of growth and security. Aggressive investor, high risk tolerance 80% stocks, 20% bonds, prioritizing higher growth. A common rule of thumb is the 100 minus your age strategy. If you're 30 years old, you might allocate 70% to stocks and 30% to bonds. As you get older, you shift more toward bonds for stability. How to start building a diversified portfolio. If you're ready to diversify your investments, consider these steps. Assess your risk tolerance. Understand how much risk you're willing to take. Determine your investment goals. Are you investing for retirement, passive income, or capital growth? Allocate stocks and bonds accordingly. Use the guidelines discussed to create a balance that fits your profile. Rebalance regularly. Over time, market movements can change your asset mix, so adjust periodically to stay aligned with your goals. Final thoughts. Why portfolio diversification is essential. Diversifying between stocks and bonds is one of the most effective ways to reduce risk and build long-term wealth. Stocks provide high growth potential, while bonds add stability. Finding the right balance can help you navigate market fluctuations with confidence. If you're looking for a platform to trade stocks with leverage, explore trading stock CFDs on crystalballmarkets.com for more flexibility. By trading CFDs, you can profit from both rising and falling markets without actually owning the underlying asset. Stay ahead of market trends and refine your investment strategy today. And that's a wrap for today's episode of Financial Market Insights for Traders. If you found this discussion helpful, be sure to subscribe and share with fellow traders. Until next time, trade smart and stay diversified.